I think we can pass to the next speaker right now. We're delighted to have Ms. Sarah Keohane Williamson. Sarah is the CEO of FCLTGlobal, an organization which brings together investors and companies to create long-term value. Sarah has an impressive career, so we're delighted to have you with us, Sarah, today. Formerly, she held 21 years at Wellington Management, more recently being the partner and director of alternative investment. Previously, she was with McKinsey, and she was also assistant at the US Department of State. Sarah holds positions in various boards and in various industries. I see here she's the director, among other positions, the director of Evercore. She's also a member of the Council on Foreign Relations. Sarah holds an MBA with distinction from Harvard University and a BA in economics from Williams College. Actually, in the past, we had Mark Tersek as a speaker, who is currently serving as a member in the board of trustees of Williams College. So, Sarah, the floor is yours. Thank you very much for joining us today.
Well, George, first of all, thank you so much for having me. I'm really pleased to be here, and I do know Mark well, so thank you for that shout out. So as George said, I am the CEO of FCLTGlobal, and we are a nonprofit research organization that mobilizes companies and investors to focus their capital on the long term. And I'm also the author of the CEO's Guide to the Investment Galaxy, which we just published a couple of months ago. And this new book helps CEOs, but also other market participants, navigate the investment community and try to understand and have the confidence to build great companies over time, which is really our goal. So today, I'd like to discuss briefly some of the insights from this book, The CEO's Guide to the Investment Galaxy, that directly impact your investment decisions, and talk about why understanding the transformation of capital markets over the past number of years has fundamentally changed the relationship between institutional investors and the companies that they own. So let me share my screen here and make sure that this that you all can see this. Does that look right? Okay, terrific. Now, sorry, I just have to figure out how to get to the next page easily. Okay, so that's a little background on me. We've talked about that. So, our view is that the goal of capital markets, if we take a step back, is to allow entrepreneurs, technologists, others to build great companies. Like if you really think about why we have markets, it's to fund innovation, build great companies at one end, and it's to drive wealth for savers at the other end. But building great companies with short-term investors is a very challenging mission. So let me give you just an example to challenge, I think, the way we think about markets and challenge conventional wisdom a little bit. Everybody believes, most people believe, that shareholders want companies that they own to succeed. It's sort of taken as a truism. But let me give you an example of Coca-Cola, which is very common, very widely held. So if you think about the shareholders of Coca-Cola, big company, about half of them either want Pepsi to beat Coke or they don't care. And that doesn't make sense. And let me explain why. If you break down the shareholder base of Coca-Cola, about 28% are retail investors. It's widely held as a retail name. We believe they want Coke to win, to be successful. Another 25% is held by index funds. They would hold both Coke and Pepsi. So they don't care. Another 42% are active institutional investors, places like Wellington, where I came from. But by definition, about half of these are underweight the benchmark and half overweight. So if you're underweight the benchmark, then essentially you're short the benchmark relative to what your own incentives are. And so, of course, the incentive, the desire would be for Coke to underperform if you were short. And so what this means is that when you add it all up, only less than half of Coca-Cola shareholders want Coke to beat Pepsi. Now, this is the kind of thing that drives CEOs crazy because, of course, they think their shareholders are on their team. You heard from the previous speaker the importance of shareholders voting proxies and so on. But the assumption there is always that they're looking out for the best interests of the company, which is just not the case. So this is where markets are today. The way investors invest and the way companies are governed has become disconnected because of the changes that have happened in the market. So let's run through what's really happening these days. So if you think about what's happening today versus in the 1970s, which frankly is still the model that many investors, regulators, and others have in their minds of the way the market works, it is completely different. So back then it was mostly retail investors. Now it's virtually all institutional investors. 70% of the trading in developed markets is conducted by computers, not humans. The global holdings of private equity firms have exploded from less than $3 billion to $8.2 trillion. So it's not the market that at least some of us were taught in school. And we have this great quote here from Michael Lewis, who says, "The world clings to its old mental picture of the stock market because it's comforting," and then the rest of it, which isn't written here, and because the only people who can explain it have no interest in doing so. So we're trying to do that with this book. So why does this matter? The reason this matters is that long-term investors are associated with superior performance of companies. When a company knows long-term investors have their back, understand their strategy, are going to stick with them, they outperform. The research is very strong on this. Our own research at FCLT, but also McKinsey research and many others show that a 10% increase in long-term shareholders is associated with an 8% higher return on invested capital. It holds true across geographies. Canada, it's 4% higher in Europe, so a little bit less, but still true. And this has a direct impact on the way both companies operate as well as the jobs they create, the innovations that they create. So that's why, that's kind of what's broken, if you will. That's why this matters. So let's now give the quick example of what this book is a little bit trying to explain. So it's called The CEO's Guide to the Investment Galaxy. And if you all remember the Hitchhiker's Guide to the Galaxy, where people fly around, a couple of guys fly around and land on planets. And on those planets, they meet a number of strange creatures. And some of those creatures are friend and some are foe. We have riffed off of that idea in this book. And so we've tried to set this up in a very, frankly, accessible, non-technical way to make both the players, but also the characters, if you will, in the investment galaxy come to light. So we really think that there are 5 solar systems, if you will, and these are the 5 solar systems of the investment galaxy. These are the 5 groups of organizations that can really affect an investor and it can affect a company. So we'll start with the asset owners, and then we'll talk a little bit about the asset managers, the control investors, the intermediaries and the commentaries, and the standard setters. So if we think about the asset managers, the asset owners, these are people who actually own the assets or manage them for beneficiaries. So they are the principals, if you will. They are managing money on their own behalf or on somebody's behalf that's very close to them. The largest, of course, of these are what we call the quiet giants. And these are the large sovereign wealth funds, the global institutional asset owners, some of the largest European pension plans we would put into this category. They're the ones today who are really driving the market. They're the ones who really own the assets at the end of the day. Then we have local institutional asset owners. That would be some of the people the previous speaker referred to, such as a state pension plan in the United States or other places, important but much smaller, endowments and foundations, families, traders, state shareholders, and so on. So you get the idea. These people are the ones who are really owning the stocks. The asset managers are the ones that probably that I worked for, that maybe many of you work for, you deal with all the time. These are people whose profession it is to manage money. They are not the owners of the money. They are managing on behalf of a client. And so the question for them is, what are the client's incentives, what incentives have the client given to them? So we think of active managers, index funds, pod hedge funds, in boutique managers, and short sellers, which we nicely call the skunk at the picnic. And I think they don't mind that moniker. Then we move on to the control investors. These people could control your company. They may think they can manage your company better than you can. The prior group, they just buy, sell stocks. That's their job. This group, they can step in and they can take the CEO's role or the board's role if they see that's right. So activists, private equity, which we call the alpha dogs of today's investment galaxy, venture capitalists, private credit, and strategic. Other big companies can obviously buy your company. The next one we think about are the influencers, but not investors. If I had a dollar or a euro or a penny for every time I heard somebody call a sell side analyst an investor, I would be very wealthy. They're not investors. They do not invest. An investor is somebody who invests. These are people who commentate. And so a sell side analyst we refer to as a weather forecaster because they take in all the information and they try to predict what's going to happen next week. And sometimes they get it right, sometimes they get it wrong. So people like the sell side analyst, the investment bankers, the proxy advisors, the financial press, who of course, takes up a lot of space. And then the index provider. So which index you are in, which we refer to as a sorting hat. The next group we think are very important, the people who make and enforce the rules. These are the regulators, the exchanges, the lawyers. So these are people that, ignore at your peril. They understanding these is very, very important. And I think the prior speaker asked a question about the difference between European regulations and U.S. regulations, for example. This is where we would think a lot about that and the role, for example, of MiFID II and SEC rule changes not aligning with each other. So where does this all get us? What is the big picture here? The big picture here is that there is a huge amount of misalignment and that misalignment really matters. So I'm going to give you a very brief case study that you may recall, which is Kodak and Fujifilm. And we have lots of case studies in this book, snippets, but I'm just going to give you a very, very, very quick one here. So Fujifilm and Kodak faced the same disruption. So what happened, if you all recall, is they both were in film, regular old film, and then digital came along. So Kodak was the market leader, and they tried to find various workarounds within photography. Eventually, they filed for bankruptcy. Fujifilm recognized its opportunity was in imaging, that in traditional imaging were limited, and they made a fundamental pivot to other sorts of imaging, protective films, cosmetics, and so on. And imaging by 2010 represented only 16% of its revenues. So one of the key differences, there are lots of differences between these companies, but one of the key differences was that Fujifilm had investors who supported this fundamental transformation away from film rather than demanding short fixes. And when that pivot initially pressured earnings, their investors didn't flee. The company had room to invest, to acquire new companies, to experiment. And that patient capital paid off. Fujifilm survived and thrived, and Kodak didn't. Kodak was much more pressured by quarterly misses, make this quarter, and they were not able, for all sorts of reasons, to make that transformation. So if you think about companies like Amazon, which didn't register a profit for 7 years, or NVIDIA, which some people seem to believe is an overnight sensation, but it almost failed in 1992. That's a long time ago. It's been investing ever since. If you think about the railroads that connected continents or the internet that transferred communications, none of these things was solved in a quarter. None of them were solved in a short-term way. So having those great innovations be backed by patient capital is what's very, very critical. And so when we think about today's challenges, whether it is climate change, medicines, breakthrough technologies, or whatever it may be next, AI, that the role of patient capital and understanding who the shareholders are and who will be able to back that is critical. So we think the investment galaxy is vast and complex, but investors are not passive tourists in this galaxy. They really dictate how the system operates. And so the question before us is, what kind of ownership do we want to practice? What time horizon do we want to reinforce in the marketplace? Which portfolio companies do we want to help through strategic transitions? And those companies that thrive in the next decade will be those that have institutional investors who answer these questions with conviction and consistency. I will stop there and be very happy to take questions. Thank you.
Thank you very much, Sarah. This is very stimulating and actually ties very nicely with the previous talk as well as with the next talks, because in the next session, we're going to hear on private equity, alternative investments. Later, we're going to hear on AI and sustainability. So just a quick question in the interest of time. So suppose that, we're talking nowadays about ESG and whether firms can improve their ESG profile. Do you think that autonomously firms can improve their ESG profile, or should the investor step in and force this change? What's your view on this?
Yeah. So my view is, and forgive me if I sound like an economist for a minute, but I think so let's call ESG externalities, because ESG means something different to everybody else. To everybody, that word means something different to different people. So if we think about an externality in the classic sense, let's say I'm a company and I'm polluting, okay? That's not very good E. If that externality will eventually be internalized, in other words, a regulator will come along and fine me for that, or my customers will no longer buy my products because they don't want a company that behaves like that. If that externality will be internalized in the future, then I believe companies can and will do it themselves if they have a long enough time frame to long enough time horizon, not long enough to get it done, but if they're looking into the future, because it's in their best interest in the long term to fix that problem. So for, a classic example would be right now with insurance around extreme weather events. Maybe some people aren't that worried about the climate or whatever it might be, but they're very worried if their own factory gets, hit by a hurricane, and they're very worried if they can't buy insurance on that factory. So if it's an externality that will be internalized over time, then I do believe the companies will do it. If it is an externality that will never be internalized, if it is a permanent externality, my own view is that is what government is for. That is what regulations are for, which is that is penalizing people for negative externalities or perhaps rewarding them for positive ones. But that it's very hard for the investor to be able to step in and do the job of the government because investors are quite dispersed and because of their own incentive structures. And so my own belief is, if it makes sense economically, the companies should do it. If it doesn't make sense for an individual company, then it's the government's job. And it's important for investors to think about what they would like to be invested in, what they'd like to earn money from. Are they happy investing in tobacco, for example? If they are, fine. If they're not, fine. But they're not going to make tobacco companies stop producing cigarettes.
Thank you very much, Sarah. I wish we had much more time to enhance this discussion. I hope we have the opportunity to host you again in the future and have a longer session so that you have the opportunity to expand all these views. Thank you very much for being with us today. It's a pleasure.